Hi, everyone. Good to see you all. The sun has finally come out in Philadelphia for those of you who have experienced the same weather. So that's a good thing. And today, as you know, we're going to talk about financing and access to quality credit. And I'm really grateful for our two speakers. So we have Kersy Azócar, who is the founder of Balance Group, which is a great name. And she has worked in the CDFI industry for over, I don't know how many years, but over a decade. She worked previously at Finanta in North Philadelphia, which serves primarily Latinx community. And I think she's from Dominican Republic, right, Kersy? And then Everett Sands, who's the CEO of Lendistry. I met Everett when I was a commerce director at the very beginning of the pandemic. Everett and I spoke because he was getting into the PPP business. He did a lot of work for the PPP program and also a really pretty big state PA Commonwealth grant program for small businesses. So I am going to hand it over to you all. Thank you. And just so you all know, if there are any questions that are pertinent to that you need an answer to during the presentation, just put it in the chat. Otherwise, we have Q&A at the end. Thank you.
Okay, I'm going to share some things with you. And then, as was mentioned previously, we're going to deliver some items to you kind of post conversation. I have on my nerdy glasses here because I've been called a nerd. I went to Penn and I am very much a believer in data. I'm very much a believer in understanding historical perspective. And so what I'll do is I'll first just give you all a little bit of who I am. We'll get right into this conversation and dig into details. And then I'll turn it over to Kersy. So first of all, Everett Sands, CEO of Lendistry. Lendistry was created back in 2015. A group of community bankers came together and we thought about how we should evolve community-based lending. Personally, as I mentioned, I went to Penn, left school, and then got into the mortgage business. Ended up sitting on the board of the first African-American bank in the state of Maryland. I was 26 years old. I really didn't understand everything that I was being taught, but I understood. This is the beginning of my lesson about systemic credit. From there, I ended up growing the mortgage company into a top 10 lender, selling it to another African-American bank. We grew that by 600%. It was what's called a mutual.
Sorry, it looks like your slide's not fully in the screen.
Okay.
I don't know if you're able to move it so that.
There
we go. Perfect. Thank you.
No problem. We grew that community bank by about 600% and then jumped ship and went to Wells Fargo. And Wells Fargo spent time in the DC area and then traveled to Southern California, where I am today. So unlike Sylvie, I do see sunshine quite a bit and makes me very, very happy. And you all, if you'd like to come see a California CDFI, you're welcome to visit me. I'm typically in a normal environment. I live in airports, but today I live in Los Angeles. And so let's just start a little bit with the history lesson. So when I was at Wells Fargo, we had a group called Correspondent Banking. And I'm going to encourage you as CDFIs to study correspondent banking. It's actually one of the things that I think we could bring to the CDFI industry. But correspondent banking is essentially where a big bank helps a little bank out in terms of doing things. And so to give you an idea, if you might know a company called PNC Bank, you might know them as what they're about to become, which is the 6th largest bank in the country. I remember them from when we were at Wells Fargo, and PNC Bank didn't have a mortgage company. They didn't process checks. They were a very, very small bank coming out of Pittsburgh, and Wells Fargo did everything for them through the correspondent banking unit. It was not apparent to customers. And what I will share with you about correspondent banking is there was a time where, again, big banks and little banks were leveraging each other. And when I was at Wells Fargo, there were 11,000 banks that were $1 billion in assets and below. This was, and just to give you an idea of perspective of time, that was a decade ago. Lendistry was created because we actually believed that that 10 to 20% of those banks were going to fall out of the market. Mergers, acquisitions, regulatory items, Basel I, II, Dodd-Frank, you can name whatever you want to name, but bottom line, it was this kind of perfect storm after the financial crisis of 2008 of low interest rates, lack of revenue streams for community banks. And it made sense, since they were getting paid premiums, to get out of the business. That's not the lesson I want you all to learn. The lesson I want you to learn is that we went from 11,000 banks to today, there's less than 1,000. So when you think of small business, what you want to think of something very basic, supply and demand. If the supplier leaves, then all of a sudden demand will increase and you don't have anyone to take care of that. I believe that CDFIs are the new community bank. And I think that we have a big, big hole we have to fill, because we actually have to replace 10,000 banks. So let's just talk about what's happened over that last decade. And that's what this slide is about. You'll see asset growth in non-community banks versus community banks. The non-community banks is here. They're growing roughly 15 to 38 billion. The community banks is a purple line that almost looks as if it's an axis line, right? But it actually is a line showing growth. And
Sorry, Everett, the slides are not moving now.
It's not moving? There?
Mm-mm.
All right, hold on. Sorry about that. Let's try something else.
I am also happy to share your slides if need be.
Yeah, I'll try one more time, and if it doesn't work,
Okay.
you can take over.
Sounds great.
All right, can you see?
Yes,
That looks great.
Is it moving?
it's moving.
All right, all right. Nothing like running a tech company and having problems with tech. Okay, so the left is $38 billion in your non-community banks and 0.47, which is sub 1 billion in terms of your community banks. So over the last 10 years, your non-community banks are growing. Most of this is due to mergers and acquisitions. Your community banks are relatively flat. So we've taken out the number of community banks, and there's been relatively flat growth, which has caused a vacuum in the market. Second thing I want to show you is number 2. As we've progressed on over the last 2 decades, there has been a concentration moved away from what is called C&I lending. I think you all know what that is, but commercial and industrial is the banking term. The colloquial term or the regular term is small business. And so you will see here, based on this slide, that the expertise in small business is declining and the loan balances for small business is growing. So what does that mean? Things that we all know. We're doing less small business loans. We have less people interested in small business loans. Our small business loans are growing in terms of the dollar size. Now let's look at this from a racial demographic perspective. So Blacks and Hispanic owned businesses. If we look here, our dark purple are our Black businesses. Our light purple are our Hispanic Latino businesses, and our gray are our white businesses. What we're seeing is that if you look at the business formation, the current percentages of businesses in organic growth, it's relatively stable. If we look at micro businesses, it's also relatively stable. And what I mean by stable is the percentages are in line. Then when we start looking at small employer, which is defined as just having more than one employee, all of a sudden the numbers start to get distorted. Which basically means if you say, hey, show me the percentage of Black businesses that are in the US, we're at 12.6. Show me the percentages of Black businesses that have employees, we drop down to 6.4. Same thing for our Hispanic Latino businesses. All of a sudden you have a crucial drop when it comes to the number of employees. Employees generally coincide with revenue growth. They also coincide with whether or not that business is going to be stable. Then when we start to look at finance, you could also call it access to capital. You also see a dive from the number of businesses based on race, and then those that are receiving finance. And so you all are an audience that already knows this, but what we're seeing is what we're describing here on the right is Black and Hispanic owned businesses are facing challenges with lower revenues. The profit margins are not there. and then access to capital or cash liquidity. And so these are some of the things that we're looking at Lendistry, and you'll look at as a CDFI, and you'll try to think about how to provide this access to capital and how to correct this. We all knew prior to the pandemic. Go ahead, Sylvie.
Sorry, just a question about this slide from Angelica in Las Vegas.
Sure.
So she asked if there's any reason why Asian Pacific Islander businesses are not reported in this, and I guess if you have any input on that.
Yeah, not any specific reason, except for the fact that when I went and pulled the data, I tried to be kind of laser sharp focus on Black and Hispanic and that. So no reason for that, but happy to go and pull the data and be inclusive.
Great, thank you.
Yeah, no problem. However, on this one I did, so don't ask me why I did in some data and some I didn't. So then we started to look at PPP. And PPP has some interesting dynamics. One of the dynamics, or one of the main things that came out, and I'm not sure if you guys read New York Times' article yesterday. It's quite similar to some of the data that we're finding, and we're happy to flip that over to you. But one of the interesting dynamics about PPP is when you're trying to figure out who is getting the money and who is servicing. Now, traditionally, community banks are the ones who normally are, at least from a marketing perspective, are the ones who you would assume most underserved small business owners would have went to. And so that would be your small bank. But what's interesting with PPP, and part of this, I think, is not necessarily related to the bank as much as it might be related to the ability to efficiently process loans. But we saw a very large disparity in where our minority borrowers were actually receiving access to capital. Now here you have your white, you have your Asian, and because I'm in California, we tend to kind of carve up Asian Pacific a couple different ways. I'm not sure if you all do that in Vegas or if you do that in other parts of the country. There's a tendency in some of the Western states like California to actually separate Chinese and Korean from other Asian Pacific Islanders. Here, they're all grouped together. You see there was overall, at least from a small bank and large bank, not that much in terms of a drawback or much of a pullback in terms of the numbers. And then you see in the small bank, they actually struggle with the Hispanic and Black. And we think that that was somewhat related to operational efficiency. And I'm going to get to that in a second and kind of talk to you about that. What's interesting here in the dynamic is that large banks, if you remember in the beginning of PPP, were heavily criticized on their ability to help underserve. And then they were able to turn the corner. Online lenders heavily weighted in terms of underserved based on racial. We're talking Hispanic and Black right now. They also were latecomers to the PPP process. Credit unions somewhat evenly balanced, but it looks like they're weighted on both sides. Finance companies, very interesting, that they're heavily weighted in Hispanic, Latino. And then CDFIs, also heavily weighted in what we were looking at as underserved, but for racial perspectives, it's Hispanic, Latino, and African American. Now we know overall that there's definitely been some conversations on the success rate, which we believe is similar to what we're seeing in normal finance. Let me just pause here, Sylvie, see if there's any questions on this slide before I keep moving on.
None in the chat at this point.
All right.
We'll keep going.
So here, I don't want you to focus so much on race as much as we're going to focus a little bit on innovation and operational efficiency. I want you to ask yourself a question. Why were the hardest applicants, at least that's the thought process when you look at the racial demographics, able to be pulled through by the online lenders and the large banks? And so just think about that for a moment as you're thinking about your CDFI and you think about how you're going to build. And now I'm going to talk a little bit about SBA. When you're doing small business lending, our experience here as a large lender is that you really need to think about things in 3 different ways. And you're going to think about your cost of funds, you're going to think about your profit, and then you're going to think about loan loss reserves or risk mitigation. I think there's a huge opportunity for CDFIs in the SBA market. And so I'll talk a little bit about SBA here. Kersy's also going to cover some of it. So I'm just going to give you some highlight points, and I'm going to talk a little bit about programs. So first of all, let's go through our 3 points. Black and Hispanic owned businesses typically seek smaller amounts of financing. 1/4 of these firms are seeking less than $25,000, compared to the 15% and 9% for white and Asian owned firms. And 54 to 58% of white and Asian owned firms, when they apply, they seek more than $100,000. It doesn't matter to me who you serve, whether it be from racial dynamics or population dynamics. My job here today is just to kind of give you some numbers so you can start to think about it. Now, when you come into the 7A program, there's going to be 4 things or 4 programs. When you come into SBA, excuse me, there's going to be 4 programs that you're going to look at as a CDFI. 3 are under 7A and 1 is under 504. So let's first talk about 7A because it's the most likely. You're going to look at the microloan program. The microloan program is going to be a program in which you will go to SBA, and SBA will provide you a line of credit. You'll originate the files, and SBA will give you a guarantee. Generally, it's plus 50%, depending on a couple of different factors. And I'm not going to go into all the different factors. The second one you're going to look at is SBA Community Advantage. It's going to allow you to do loans from effectively $1 to $250,000. And those guarantees are going to be 75 or 85%. And SBA is also introducing another program called a direct loan program. It will depend on the reconciliation bill in terms of when it comes out. But the expectation is that this program will come out in January, February next year. There's going to be a technology integration with SBA, and SBA is going to help with some of the underwriting. At least that's the way it's written today. I bring up all 3 of these programs because if you plan to serve any of these dynamics here, these are 3 programs that you might want in your arsenal and in your war chest. The 504 program historically has been for those that are called Community Development Corporations or CDCs. But I also want you to pay attention to it as CDFIs, because there is in the reconciliation bill the opportunity for a CDC to also do working capital facilities up to $1 million under the CDC program. You will either want to think about becoming a CDC, or you will want to think about partnering with a CDC if this is possible. Because similar to that direct loan program, with this new 504 debenture program, SBA is considering balance sheeting the loans. Why do I bring this up? Because traditionally as a CDFI, you're looking for capital. And if SBA is willing to balance sheet the loans, it means that it's going to be very similar to PPP, where they pay you a fee and then they take the risk. Let me pause here just for a second and keep going. All right. Now, what I want to show you here is top lines of businesses for CDFIs, just so you know what your colleagues are out there doing. And then number 2, I just want to show you kind of as it relates to minority clients, how much of the book of business are CDFIs generally covering. So again, this is just data and information that I thought would be important to you. As my understanding is as you're thinking about building, evolving, and growing your CDFIs, or maybe you're just thinking about new products. Finally, I'm going to tell you a little bit about Lendistry. We were asked to talk a little bit about innovation. And so we are considered a fairly innovative CDFI. And so here is just who we are. So our business model is somewhat of a non-traditional model. It is a mix of a fintech company and a community bank. We consider ourselves one of the only, if not the only, fintech CDFI in the country. We've got about 300 years of banking experience and some significant tech experience. When we started in 2015, we started to build our own technology because we felt that we could not find tech off the shelf that was as responsive and as evolved as what we would want. This year, we will lend roughly about $10 billion in capital. We will support, well, I should say disperse, because we're doing grant programs too, roughly about $10 billion in capital, which equates to about 600,000 small businesses across the US. We're a CDFI, we're a CDE, we're a member of Federal Home Loan Bank, and we're also an SBA lender. When you start to think about innovation, and we get asked this by several mission-based lenders, we tend to think that it breaks down into kind of three ways. And so this is just a quick diagram. Obviously, the devil's in the details. But I do want to encourage you to think about things, whether it be from a technology perspective or a loan product perspective. First, start with a trial. Then start to think about scale. And then run an analysis on your cost of funds, your risk, and your profitability. I know I'm kind of, giving you kind of really high level, but I think it's really important about how you think about technology. And I think it's really important about how you think about products. The reason why I say a trial run is you got to make sure that it actually works and what you're thinking about will actually be able to be executable. The reason why I suggest that you think about scale is because what we're still trying to learn in the CDFI world is how to get scalable capital and big sources of capital. And we have a tendency to think about programs in small amounts and then wonder why the capital is not coming. The reason why I give you the third box here of an analysis of cost of funds, risk, and profitability is because it's our belief at Lendistry that these are the three components that are the most important when you're thinking about anything in your CDFI business. Where are you going to get the money from? How much does it cost? How much risk are you taking? So there's innovative and there's being responsive to the community. There's also making sure that your CDFI will be here tomorrow. And then there's profitability. And the reason why we include profitability is because when you think about profitability or you think about the investments you want to make in people and tech and resources, profitability is a huge factor into that. As I dig a little bit more into the three, one of the things that we've been asked at Lendistry is kind of the how we do it. And so I'm going to give you a couple of examples. In the state of Pennsylvania, we partner with 17 CDFIs to create a program that produced in 20 days, 64,000 applications, $1.1 billion in requests. In the state of California, we partnered with roughly 33 mission-based organizations, so chambers, CDFIs, et cetera, leveraging technology. We took in 344,000 applications for $4 billion in 15 days. And we have multiple examples of this. We've run about 15 different programs. But one of the things that we're very interested in at Lendistry is capital deployment. And it's not just doing big numbers of applications and big amounts of financing. It's about who are the capital deployers, who's sitting at the table, making the rules and making the decisions about who gets the capital and the application and the process flow. So one of the first things I want to encourage you all to do is think about that capital deployment role as a CDFI or as a collaboration of CDFIs. How do we think about ways that we can come together so that we could be deploying capital to underserved communities? If you remember, my very first thing I talked to you about was how a small bank will go to a larger bank and they would work together to provide banking services like Wells Fargo and PNC Bank. How do we think about as CDFIs coming together so that we could collaborate and so that we can help our communities receive access to capital and evolve? The second thing is tech. We need to think about uniform processes for our applicants so that they don't have to go through multiple streams and various streams of applications And so that no matter what they experience, it's somewhat similar. And this is something that I think we need to bring to small business lending. If you apply for a home, you receive something called a Uniform Residential Loan Application, also nicknamed a 1003. No matter where you're at in the US, you generally receive the same application document when you apply for a home mortgage. We need to think about things like that as it relates to small business. And then thirdly, as we think about innovative products, we want to remind all of us in the CDFI industry that we got to hear from the community. We call it customer surveys. We got to understand the capital landscape. These are things like, should we be providing term loans or lines of credit, interest only? How do we help and be responsive? And then how do we create responsible capital stacks? And when you think about responsible capital stacks, that's how do we include not only the traditional source of financing like banks, but how do we think about our nonprofits, our foundations, and other sources of capital that are looking to deploy capital today. And so I'll pause here and I'll stop and I'll turn it over to Kersy.
Before you start, Kersy, just thank you so much, Everett. That was great. So just a couple things, as you guys know from last session, this is what I do. I just do a little quick recap of a couple highlights. So some really, really good data there. That statistic around there being 11,000 banks down to less than 1,000 is pretty poignant. And definitely highlights the need for CDFIs, but also this sort of burgeoning fintech industry that you're part of, Everett. You definitely highlighted also the disparities, and just interesting to see how online lenders are serving more Black and brown lenders than white, and also CDFI. So definitely great statistics there. And thanks for highlighting the new SBA program that's coming for CDCs. That's really good to know about. And then some good primer there in terms of if you're thinking about creating a fintech sort of lending model, really piloting that and doing a trial and assessing the risk. And then definitely want to highlight, you mentioned through the example of the program in Pennsylvania, the importance of collaboration. So while listening to your session, I tried to pay attention to all the questions in the chat. So we'll go through, I have just a handful here before we turn it over to Kersy. So there was a lot in the chat around statistics. And so I don't know if you have answers to this, otherwise they'll be provided later, but around Native Americans, if you have any information around Native Americans and why those stats aren't included, or if you have information around lending to Native Americans. And there was just a question around the data, if that was national data or California data, since you mentioned the distinction in terms of how the Asian Pacific Islander population is defined. Yeah. So that's the first question.
Yeah, no problem. So all data I gave you is from the FDIC for the most part. So all national data. I do believe the FDIC breaks them down into several different categories. Of course, you can look at the data behind the data. So I try to give you things that you can turn around and you can research. It's all footnoted in the presentation. So you're welcome to dig in as deep as you like to go. I'm not as much as a data junkie as some of my other team members who will dig. I try to make it somewhat concise. And I apologize to you guys if you wanted to have additional racial data, but I will make sure that you at least have the background information so that you can dig as much as you want.
Great, thank you. The second question was if you can provide some commentary, since you're in this space, around the ability of online lenders to serve, to reach the underserved population.
Yeah, so I will tell you what we did, right? So you have me as a leader who came from 2 African-American banks and then jumped into a national bank, right? And interestingly enough, at Wells, top 1% in minority lending, top 1% in LMI lending. But what I found at Wells is that we still weren't serving the customer exactly the way we wanted to. When I got into the CDFI world and I really got into tech, I really got to do something really, really basic. And I know this is going to sound crazy, but we did something like we just looked at when customers were applying. And I'm going to tell you exactly how it happened. We were in a group with CDFIs. We had an individual come in, and there was there was literally this big debate about CDFIs about how to get people to education classes, right? We were talking about offering them for free. We were talking about all these different things. And a small business owner raised their hand and said, hey, would you mind just putting this online for me? And then I'll just watch it while I'm driving, or I'll watch it while I'm on the train. And, that little simple thing to me made me go, let's see exactly what time people are applying. And what we realized, and this is what I kind of say cliche now, banks are open 9 to 5, businesses are open 5 to 9, right? And so what we mean by that is, as financial institutions, we need to adjust the intake process because the business owner is running their business. And so those are the different things you need to think about. The other thing you'll hear me talk about, where I talk about having static applications and different things like that. Someone in Vegas should be able to call someone in Philadelphia and say, this is how you apply, right? We're missing a little bit of that community education. And what we've instead said is, okay, you've got to learn all these different ways of how to apply. And the small business owner is not reacting positively. However, when we've done that inside of our programs, like for example, in Pennsylvania and in California, New York, and all these other places that we've done it, we've noticed that we've seen a sharp increase of applications when the community can basically self-educate itself. And so there's 3 things that we've invested in Lendistry I would encourage you to do. One is think about making 24/7 applications available. It doesn't necessarily mean 24/7 somebody's there to answer a question. It just means they have the ability to apply. 2, think about how the document delivery process works and how you give examples of documents. And what we've created in our application process is videos. So every single day, it doesn't matter if you're entering your social security number or you're entering a document, we have a video that shows you how to do it. And then the third thing is I would ask you to pay attention to the data. You'd be surprised how many people apply at 3 a.m., 4 a.m. and 5 a.m. You'd be really surprised, or 11 o'clock at night and at midnight.
Great, that's super interesting. Thank you. Couple more questions and a few are coming in. So how do you reconcile risk and profitability with technical assistance services for CDFIs?
Yeah, so I think the technical assistance lowers your default rate. That's the high level answer, okay? I think what we need to do as CDFIs is we need to innovate technical assistance, right? It is not a silver bullet anymore, right? The old school is, look, let me sit down with you and let me talk to you about technical assistance. That is needed. New school, I don't want to talk to you. Just give me my money, right? And so you got to figure out how to balance both of these customers that are coming through the door, because the ecosystem is both customers, right? I have twin girls that are 12. They are not going to sit down with you. I'm telling you right now, when they become business owners at all, right? They don't want to walk into a bank. They don't want to talk to you. They think everything should be available, right? If I ask them a question, they say, Siri, what's this? Google, what's this, right? They don't even if I gave them a dictionary, it probably hit me upside the head or something like that, right? So we got to know our customer base. As it relates to you as leaders of CDFIs, you need the technical assistance because you need to decrease your loss rates, because at the end of the day, your investor expects to get paid back. And so I think that's important. I also think, and this is my last point, you have to understand capital stack better than kind of the common person does. And so what that means is, there's just like a customer has a layer of finance, you should have a layer of finance inside of your CDFI. So you might have a main investor that gives you a significant amount of capital, whatever significant is to you. You might have a second investor who gives you what is called patient capital. And you might have a third investor who might give you money that, effectively you could lose. And if your investors can't do it, what programs are you participating in? So for example, I mentioned SBA. Another one I will mention to you is called SSBCI, State Small Business Credit Initiative. Every state in the US in December will be applying to Treasury for what will equate to roughly $10 billion. They are required to then turn around and use that on credit enhancements. And inside of the law, there's a certain percentage of that money that has to go to 10 employees or less. So if you're not involved in the decision-making process, right, this is where I talked about capital deployment, and you're not involved in these SSBCI programs, because they're literally meeting every single week on a state level to talk about the programs and how it's going to get rolled out and how you get the money, that's your third layer of capital that you don't have to pay back. So I would encourage you to be extremely involved in that.
Great, awesome. The next question, I have just three here, and then we'll move over to Kersy. Have you seen any partnerships between CDFIs and banks that have worked to help with lending? Director?
Yeah, I mean, we're probably, so we have three types of partnerships at Lendistry. We have banks and financial institutions, we call it banks and FIs. We have private institutions, and then we have government. So one of our biggest partners, most people know, is Goldman Sachs. Goldman Sachs runs something called 10,000 Small Business, 10,000 Women, 1 million to Black women. Goldman Sachs has all three of these programs, and they have no small business lending department. And so what you want to do as a CDFI is you want to target banks that either don't have small business lending, maybe they're trying to build their small business lending, or maybe they're inefficient from either a regulatory perspective or some other perspective that you might be able to help out with. I believe that all regulators encourage partnerships, right? As long as that they're the right partnerships. You all might have heard, but we partner with Amazon, and we build Amazon Community Lending. And so we're the only community lending partner who built that out for Amazon. And we have other private institutions that we're talking to build out their products. So that I think the landscape is very, very ripe for us if we take the actionable steps.
Great. And I'm going to merge these two questions into one, because I think that works. And then people do have an opportunity at the end to raise their hand and ask questions as well. So there's a few questions around scale and just how to leverage, since technology is expensive, how to leverage technology to scale. And if you have advice around specialists, experts, consultants, for those who might be working on building CDFIs or adding technology to their CDFIs.
Yeah, I'll give you my email at the end, or it'll be on the presentation. I would say email me, because there's a variety of different things. But I'll tell you, we started with 4 people sitting around a circle table with our cell phones. And now we have 400 people and 600 contractors. So we have about 1,000 people at our CDFI. There was a time when we didn't do our own closing docs. There was a time where we didn't do our own servicing. There's a variety of different things we didn't do. And so again, going back to my bank correspondent lesson to you, is that as CDFIs, we've got to learn how to learn what we individually can do best and learn how to collaborate with each other.
Great, thank you. Good, always good to end on the note of collaboration. Thank you all for those great questions. And now, Kersy, you are on.
Thank you. And Sloan, yeah, thank you. You can. Well, after such a great presentation from Everett, I think this is a good follow-up to that portion, and I'm happy, Everett, you share so much data, because sometimes we hear about the economy, we hear how all small businesses are doing, but it's good to see tangible information. Next slide. So before we begin, I wanted to mention that this presentation is based on my experience managing the lending department for 10 years at the CDFI that I worked at. And so a few things to consider is that we want to be mindful of like the before and after the pandemic. Once COVID hit, I think everybody had to shift the way we do technical assistance, the way we approach clients, the way we do applications. All this information is reflective of my experience, and some data may differ from maybe what Everett is presenting, depending on the source, but they should be pretty close. And I'm not endorsing any particular company. And the last thing that I wanted to mention, I have a picture of apples here, is that it doesn't matter what approach we take when we are presenting the challenges that small businesses have. But bottom line is that they are similar challenges, or maybe the same challenges. It doesn't matter where you are. It's just the way we are interpreting those challenges. So just want to start with that. Next slide. So what the data says. So we know that, as we witnessed, majority of small businesses, they have fewer than 5 employees, and some of them have no employees. And the pandemic has disproportionately affected our Latinx and immigrant-owned businesses. And here I'm emphasizing the Latino and Latina community because mainly that's the community that I worked with in Philadelphia. And immigrants accounted for 29% of all entrepreneurs in 2017. And firms owned by communities of colors were more likely to report that.
Let's go.
Yes. Oh, I thought you had a question. They reduce business operation. And my last comment about that is also about women, that even though they make the majority workforce, putting them at risk, have less opportunities, and 83% of women reported significant increase in depression. Next slide. Some additional information about, and I'll briefly mention these particular slides. I just wanted to emphasize the number of jobs, like small businesses with no employees. And I have different information for all the different states that you represent, and you're gonna see the same pattern. For example, in Pennsylvania, there's a total of 1 million small businesses, right? And out of those, 865,000 have no employees. And you get to see like how impactful our small businesses are, and yet they don't get resources, they get less loans. And when you compare the data, so this is 79%. Next slide. So same thing in Florida, huge amount of small businesses, and this is statewide, not specific to a particular area. 2.3 million out of the 2.8 small businesses. And next slide. Nevada, same thing. And I listed where the information came from. This is the latest information from the Small Business Economic Profile from the SBA in 2021. And next slide. Minnesota, same thing. Out of the 533,000, 416 they have no employees. And I think there's one more. And South Carolina, 445, and we have 363. So this is important to see the pattern. Like everywhere I go, I hear, oh, small businesses are the backbone of our community. Okay, so what are you doing to help our small businesses? And it feels like we have this bucket and we want our small businesses to fit that bucket instead of being innovative. How can we meet the small businesses' need? And Everett mentioned a great example. If our application is not available for somebody to fill it out at 3 in the morning, then they're not applying. And the dynamic with immigrants, it's like another set of challenges. And we also want to keep in mind that small businesses have different needs based on their size and their stage they are in. Because if you are a pre-startup and you don't have a polished business plan, 20 to 30% down payment, it's very unlikely that you can get a loan. So how can you get a business plan? How can you get more resources? So it's very challenging. The same thing if you're expanding. You need money to make money. We always hear that, but how can we facilitate that process? And here I wanted to highlight how, and I'm sure you know most of these, if not all, how our immigrant population faces additional challenges. I attended a webinar a long time ago, and I was in shock hearing the presenter saying, like, well, this is how the process is, and you either take it or leave it. I'm like, oh my goodness. And we see that all the time, right? That our applications may not be in Spanish or in any other language, that our small businesses have limited knowledge of technology. Maybe they don't have a computer, they don't have a laptop, they don't have a website, they cannot do online sales. In particular with PPP, when the pandemic hit, and I'm gonna mention a little bit more later, it was overwhelming to see how unprepared our small businesses were in terms of technology. Insufficient access to capital, maybe they don't have credit, they don't understand how credit works. And this goes, this is a general, it could be an immigrant or non-immigrant. This is always a challenge. And limited financial literacy, not understanding the documents that we need to fill out to complete the loan process. And other things like not having enough mentors, not understanding what are the laws and regulations, if you need zoning for your business, if you need a particular permit, and very important, the lack of trust in financial and banking industry in general. And next slide. And in addition to that, so we know it's not a secret that female entrepreneurs were more impacted during COVID. And also, I wanted to have this slide here because we often forget that women have another set of challenges. Like we have the imposter syndrome, we have the glass ceiling, right? And when you're a businesswoman, you have the same challenges. I always tell, like I'm searching for quotes for logos, and the first thing I tell the person is like, look, women don't negotiate, just give me the price and I'll tell you if I like it or not. And then they start laughing. I'm like, yes, like give me the price. I'm not gonna go in a back and forth. Well, I don't know, it's just, and kudos to women who negotiate. But these are things that it could be cultural, it could be the way we were brought up, how society perceives us. There's so many challenges. And I highly encourage all of you, all of us to play a bigger role in making programs, financial capability, technical assistance that is tailored to female entrepreneurs. And my dear friend Lenny from Widener's BDC is here. A couple of years ago, we launched a female entrepreneurship program. And it was very interesting to see how these women in the right environment can thrive. And again, it's just like very important, all the challenges that women face, and we're often have like a bigger burden and is again often overlooked. And let alone applying for a loan. Like I always say, you're Latina, you're a woman, right? You're declined at the door. And this is the statistics, this is what all the statistics are telling us. I remember I was going many years ago, I was going to get a credit card, and then the banker is like, oh, you should get your husband on the application. I'm like, look, I make more money than my husband. I'm a loan officer. And it's just like, why do we still have to face this? And again, the opportunity, if I know this, I know how to fight it, but you don't know what you don't know. And that's why I think it's important for us to have this. Next slide. So with regards to the disparities meeting needs of small businesses, very similar to what Everett said, we see that yes, there's a big noise, we're supporting small businesses. Okay, so what are we doing to meet their needs? And here's an example of PPP, because when the pandemic hit and then there's this great opportunity to get funds, you first needed to have a relationship with a bank or a lender to get a loan. And also priority was given to larger businesses. So there were so many small businesses excluded from the first round. And I believe the money ran out in a week and a half, like something crazy. And all the other things that I mentioned before, technology, we were asking our clients, look, send me everything on a PDF. What is a PDF? They didn't know how to submit, how to scan documents. And also, when we ask about their formation documents, they could have a corporation or an LLC. They didn't have an operating agreement. They didn't have bylaws. It was very, I don't know, it was an eye-opening situation to see how unprepared our small businesses were. They didn't have all the records in order to document. They were doing payroll for their staff. They were running their businesses without a business bank account, so they couldn't get their checks deposited. And these are just a few of the challenges. Very interesting, grants versus loans, because when we say, let's help you, let us give you a grant, the first thing our small businesses say is like, okay, this is not true, you're tricking me. And I go back to CDFIs because it takes trust. So somebody that you trust have to tell you, yes, this money is free, apply, so they don't think it's a scam. And when you are applying for a loan, typically the heat of the pandemic and even now, banks wants to see that your business is growing, that everything is rainbows and flowers, that you have 6 months of emergency, the equivalent of 6 months of payments saved in your bank account, perfect financial projections. And then who's gonna help you with all these things that you need for to document that your business is viable? And also there's the fact that with the individual taxpayer identification number, they're also excluded from federal programs. So there's a lot of small businesses that cannot access these programs. Next slide. So when we think about the traditional banking requirements, the 5 Cs of credit always apply. Even when I was managing the microlending department, doing microloans, character-based loans, these 5 things always apply. You just need an additional layer of trust, but everything else, you want to see how the business is running, if the business is making money or not making money. But when we think about a regular bank, then things get more strict. And my question here is, what about implicit bias? Like, we know it exists. The way we dress, the way we look, the color of my skin, that's gonna determine if I'm gonna have more requirements, more documents, if I'm gonna be denied, like I didn't even complete my application and I'm denied, or I'm not given the opportunity to know that you have a 0% interest loan, that you have a line of credit, that my loan could come with a credit card. And again, that is putting me in a disadvantage, because if another business can access a financial program or product that I cannot get, I'm already at a disadvantage. And I always tell small businesses, this money is for you. The CARES Act allocated this money for you, but then we're not accessing this money. And it's very painful to see how when small businesses come to community organizations or small banks, you get to see that they're already distrustful of everything, because they have had a very bad experience with the whole process. and perhaps multiple times. My friend a couple of days ago told me, look, I'm changing my bank after 15 years. They've never done anything for me. And this is what we are sometimes. We are a number. And if I'm asking for $5,000 and then Everett is asking for $1 million, so he becomes the important client. It's too much work to do a small loan. It's too much work to show me the way to get approved. And next slide. Yes, and then this is just briefly because this topic alone, we could take a whole day speaking about predatory loans. It's very sad to see that when a small business is denied an opportunity to have a good loan that you can pay interest, that you can pay capital and interest, then what they do is that they go to the street and they go into these bad loans, predatory loans, sometimes at 400% interest. That is just a recipe for disaster. It puts a lot of burden in the business. They go out of business. It's just very sad to see how this practice is still going on. Next slide. So with regards to federal SBA programs, I can share that I've been working very closely with the Emergency Injury Disaster Loan Program from the SBA. If you are not fully aware of what it is, I put a lot of resources here. I highly recommend you to consider this. I have like my 2-minute pitch to all clients. I'm like, look, this is a loan, but wait, before you say anything, it's a 30-year loan, 3.75%, and 2 years with deferred payments. And during that time, you can recover, triple the money, and pay it off early with no penalties. And they're like, oh, I get it. But if I don't take the time to know that they already say no because they're debt adverse, then they're missing on this opportunity. And another aspect to this is a lot of back and forth with the SBA. It's like, I didn't receive these documents. Can you upload this? So it's important to have somebody doing the hand holding with the small business. Out of all the applications I submitted, maybe like 30, 25, something like that, all of them have been declined. And then I resubmit a reconsideration. I'm like, hey, why are you declining this client? And guess what? They've been approved. All of them. All of them were declined, and all of them were approved when I submitted the reconsideration. I think I already know all the names of the loan administrators. But what does that say? Like, what does that say when we are facing these barriers? Our small businesses are being, and what I hear is like, oh, I got declined. I'm like, no, don't worry. I'll resubmit the reconsideration. It has like being declined for something, it has a negative effect. I think we take it personally, right? And then, especially if it's money, it's like, okay, you don't trust me. And so yes, I'm not gonna say anything bad about the anything else, but I highly recommend you to explore this opportunity. Is a great resource. Any of you who have businesses, if your business was opened in January, I believe 2020, you're eligible, so please apply. Next slide. This is just FYI. Everett covered the 7A loan and other loan programs. I just wanted to highlight all the different financing that the SBA offers. I'm most familiar with microloans. Those are 50,000 and under. So the other ones, the 7A or the community loan, I know them superficially, but just know that there's a lot of different options for small businesses when a traditional loan is not available. Next slide. Okay. And then these, I wanted to briefly mention this because there's a lot of money in the federal government, and there's a percentage that's set aside for small businesses. And guess where that money is? Sitting down on that account, because our small businesses are not reaching that money. They're not. And again, I can mention Widener SBDC. They have a procurement technical assistance center. So our small businesses are not alone. They can have a business coach, a business counselor, walk them through the process, help them apply, but they don't know. And I always tell small businesses, look, if you become minority certified, if you start doing business with the government, that's very helpful for your business. It elevates the status that you have, because now you're doing business with a great client. So the government is saying, I like you, I want to work with you. So other businesses can come after that. And I put a link there, so I encourage you to explore the information. And yes, I am looking at the notes. See, yes, I've worked through the process myself. I still find it a little bit complex to become minority certified and all that. And it's not for all businesses. Maybe if you're only making $20,000, it may not be for you, but this is something to consider. Our small businesses don't even know they have that opportunity. And with regards to financing models, I wanted to add a little bit more to what Everett mentioned. I was part of that initiative when the 17 CDFIs got together, and this is from their website, over 14,500 grants and $249 million dollars. Such an amazing work, and the spirit of collaboration, the spirit of, let me help you with the application, a lot of meetings back and forth, a lot of training, but this is what it takes. That's how we get to help our small businesses. I think it's not like us having our small businesses reach us, it's just like us being at the same level of our small businesses and realizing what will it take, and not being happy with doing the bare minimum. If you think that doing 10 or 20 loans every year makes you happy, I'm gonna challenge you to reconsider that. As you notice, so many millions of small businesses, if 79% of your businesses or 80 or 60 are small, why not create a product for our small businesses? Maybe it's a low doc product, maybe it's just like a conditional product. Well, you need to take this class in order for you to get 10,000. I'm gonna give you 5, and then you can access 10. What can we do to reach our small businesses? Next slide. Looking at the time, making sure I don't go over. These also, I wanted to showcase just a graphic of all the CDFIs in the nation. And again, going hand in hand with what Everett mentioned, look at the map. In some areas we have a lot, and in others, well, never enough, but in others we have zero presence. And even with the number of CDFIs, it's not enough because they're understaffed, underfunded, right? And they're carrying such a heavy lift that the big players are not doing. So there's as you know, right? So there's just like a huge disproportion in terms of the work that CDFIs are doing and what needs to get done. And on top of that, if you add that a lot of these organizations are old-fashioned, that their staff may be, I don't know, like in a way robotic, like, okay, I do this and that's it. Imagine it's like half of them are carrying the weight of the entire country. So again, exploring different models is very important. Next slide. Yes, these are just different examples, not again, just organizations that I've worked with that I know they have done an amazing job internationally, or they have a national outreach. And I encourage you to visit their websites. And for example, with Kiva, I know is very popular, but one of their downsides is that these only works if small businesses have a social media platform. So if you have a lot of followers, if you are very active in social media, this is great for you. So in a way it's good, but then it is also excluding a huge portion of our small businesses that don't have a great social media platform. But all these organizations have innovated and created different products that are helping thousands and thousands of small businesses. I remember when Acción Fund was created, they created this great platform where they could approve clients with like a green, yellow, and red status, and it was just like very easy to approve loans. So all these organizations have done an amazing job innovating. And this case study is a real client. And I just used a different name, but this is what it takes sometimes to move someone from, I don't know, like helping them get out of the cycle of poverty and drastically changing their lives. When this person came to ask for a loan, she already knew that she couldn't get a loan anywhere else because she had a multi-service business and she wanted to open a brand new industry. So she traveled, she got all her certifications, she took all the classes she had to take. She's like, okay, I'm ready. I just need a small loan. So I gave her a $25,000 loan and she didn't have a lot of money. I'm like, okay, I liked all the information that you're telling me. I really believe that this is something good. And these 25,000 helped her open her business, get the contracts that she needed. And in her second year, she grossed $3 million. And in her third year, $5 million. So this is what it takes. Sometimes something so small can change the life not only of herself and her family. She employs 115 people. And if nobody had given her this opportunity, maybe I would be sharing a different story. So again, something very small, a microloan can go a long, long way. Next. And very briefly, I want to mention that these are, in my experience, the main pillars of character-based loans. We first start with trust. We want to make sure that our clients trust us, that we earn that trust, that we understand their real financial picture, making sure that if they have a different set of taxes, that we know how their finances are, and setting up expectations. I always tell our clients, look, this is what we need. I need to see your taxes. And if I have questions, I may ask for additional information. So this is very important when we're working with our small businesses because they may not be used to the banking system. And I think next. And yes, let's not forget, yes.
Sorry, just if we can wrap up. I mean, I know you started a little late.
This
Just to
is
make
the
sure
last
people have time
one.
for questions. Great, thank you.
Thank you. Yep, this is my last slide. I just wanted to share that what I shared is just one portion of the challenges that our small businesses face. If I live in a bad neighborhood, how can I be thinking about growing my business? If my kids go to a bad school, the same. If I don't have the vitamins in my body that I need to operate, right? If like all these things, if I don't eat properly, so just always consider this. that is a holistic approach that we should take when we think about helping our small businesses. Yes, and that's it. Yep, I put some resources there.
Thank you, Kersy. That's great.
Thank you. Thank you.
Well, thank you. So now we definitely understand why your business is called Balance, because thank you so much for reminding us of, how the humanity of entrepreneurs, and those statistics, and, just that statistic around depression for women and the barriers that people from different backgrounds or that you can, that gender can pose. And that a lot of these processes are flawed, that a lot of them require documents that are hurdles that are too much to overcome, or might require a reconsideration process after a denial, which is, as you said, very harmful. So that was really helpful in terms of just making sure that as we're doing this work, that we're approaching people and really understanding the barriers. So there were just a couple questions that I caught, and then I want to open up to the group. There was just a comment about the need for pre-underwriting programs to make sure the businesses are ready before any programs are launched. I don't know, Kersy, if you have any experience with that or any comments on that.
You mean if a brand new CDFI wants to start doing loans for pre-startups?
Well, programs, I think the comment was around making sure that businesses have everything together before programs are launched, or to be ready for submitting applications for grants or loans.
Well, if I knew the answer, I would be a billionaire. But I think, and I don't mean it in a bad way. It's a great question. I think we're always in search of that. Even how can we make the process better? And going back a little bit to what Everett mentioned, that his children, like everything virtual, the clients that I worked with, they prefer the face-to-face interaction. So working with them, even after they attended a webinar explaining the process, they need a lot of hand-holding. So I don't know if that's helpful, but just explaining and I know now a lot of the applications are done online. And I find that if you have a 15-minute conversation and you explain and lay out the process, that's very helpful.
Everett, I don't know, you're nodding your head. Did you have anything you wanted to add to that question around getting people ready before they apply?
Yeah, I mean, I think we do a lot of it. I think we could just think about how we want to evolve it. So Kersy mentioned like the 15-minute conversation. I would record the 15-minute conversation. I'd send it out an email. I mean, just look at how many people in this chat have asked for the deck, right? I mean, right? So it's like people do want to go back. They want to re-review. They want to understand, especially when you're talking about something critical like small business or home financing or something like that, and they deserve it. I also think it's important for us to think about truthfully in pre-underwriting those little questions we can ask up front to help prepare, because that is what you do when Kersy sits there for 15 minutes, right? There's a couple questions you're asking, there's a couple documents you're sharing with them. And then the other thing I would just bring up is we're using now examples of documents. So you can get an example of a W-2, you can get an example of a Schedule C, you can get an example of a K-1. The CPA has it, your accounting team has it, or just Google it, right? And just go to images. So we're doing a lot more examples of documents and putting them in front of people. And it seems to be working really, really well.
That's great. So record it and provide examples. That's excellent. There were two questions from Lancaster. I'm sorry, I don't know if it's Ole or Ole, O-L-E, but I'm going to let you ask your questions just to make sure that they come out of your own mouth if you're still here with us. Perhaps not. They had to do with sort of how to help an entrepreneur if they're applying for a loan at a local branch, but the decision is not being made at the local branch and is coming out of a more centralized office. I don't know if you have any, you probably would be a billionaire if you had the answer to that question too, but
I can definitely, yes, that's a high high priority issue, and that's causing a lot of challenges, because as much as I know that somebody has the willingness and the capacity to pay, if I'm not the decision maker, that's a problem. So I guess one of the solutions is to become a CDC, right? And partner with the SBA for I think as CDFIs, in a way, you need to have control of the loan decisions to help the community, because otherwise we go again in this vicious cycle that the strict underwriters that are set on you need to have everything perfect are the ones making the decision.
Great, thanks, Kersey. It looks like, oh, they said he can't come, the system will let him come off mute. So hopefully I captured that for you. If others have questions, please just raise your hand and we'll call on you. Either virtual, well, ideally the virtual hand, because then you get raised to the top and I'll definitely see you. It looks like there's a, let's see.
Sylvie, can I add to one thing while you're looking?
Yep, absolutely.
I think one of the other things we're seeing, Kersy said it really, really well, cultural competency. And I just want to add to it, because I think Kersy, and just so you all know, she's amazing. And she is aggressive, because I remember doing some training programs and she's like, why don't we have these things in Spanish? Why don't we have these things in? So I just want to bring up a couple of things that we've done because one, we're all community, we all care. And let's be clear, Kersy cared, right? And so her points were valid. You know, at Lendistry, we added translators to every website. So not only is it the application, but it's our actual website. We added accessibility for those who are disabled. We've now changed our training programs, and what we're trying to do is inside of our loan fundings, we're asking the small business that they will volunteer. So we give them a little bit off the rate. We might give them a discount off their fees. And so what does that mean? Cultural competency is a woman restaurant owner should have a woman restaurant owner teaching her, right? And you can record it and you can videotape it. You can throw it on a webinar. You know, if it is a Black business owner, it goes better if there's a Black instructor, right? If you can have things in language, these are the things that we're now doing to transform our CDFI. And I would encourage you all to just consider it, because the responses, we do net promoter scores and different things like that, are amazing. And what that also, and we also are tracking, you might not want to do all this, but we're tracking if the videos are being watched more, and if they're paying attention more, if they're staying on longer, different things like that. So just some things I wanted to share with you all as we're thinking about cultural competency, which I think has to be top of mind as we keep moving forward.
Thanks, Everett. That's really great. Matt, I see you have your hand up.
Yes, indeed. Thank you. Well, this is a question that I'll admit is a little bit focused on our particular business model. We are a CDFI in central Minnesota. Hopefully it has maybe some relevance for others. It relates to business models of CDFIs. And I saw there was another question about partnerships between CDFIs and banks. And in fact, we are wholly partnered with banks. Like, we are primarily a gap lender, meaning the lenders are the pipeline for deals to us. And in instances where they can't go beyond, say, 75% of the deal and the owner can't bring the rest, we'll lend the gap on a subordinate basis. And that's great. And we've done a lot of great things in that way. But to grow, I'm wondering what other opportunities there are, other approaches. We do some direct lending on a micro basis, and oftentimes with entrepreneurs that have gone through a training program of ours that really is the main focus of our participation in this whole program. But knowing that other CDFIs are growing in different ways, and I only kind of know the world from where I sit, I'm curious about, how do other CDFIs generate deal flow apart from banks? I mean, we can't afford big billboards and stadium sponsorships. So how do others do it?
Yeah, I'll tell you from our standpoint. To us, banks are just an example of anyone that receives clients. So, the common things that come top of mind are your chambers, your SBDCs, and different things like that. We tend to think of that as our grassroots groups. And so we go after the grassroots groups. Then we started to get into private institutions. And so we have partnerships with anything and everything you can imagine. Our private institutions are McKesson, Cardinal Health, airports across the US. We have a variety of different private partners. And generally, I know these things sound big, and just to be clear, they are big today, but they did not start that way. Right. And so what happens is you meet your local chamber and they refer you to, someone like Sylvie's old position. And then, then that spirals into you have a relationship with the government institution, and the government says, we have these initiatives here, there, and everywhere else. And that's how we get to like an airport or something. So that would be one of the things I would share with you. The other thing I think as CDFIs, when we talk about collaboration, is we have to understand the success of a small business owner. And we still have not defined that for small business, right? So why wouldn't I partner with Kersy if she's dealing with microloans? Let her master that, let her be amazing at that, and then let me be something else, and let a bank be something else. And so if you think about education, it's very clear, like elementary, junior high, high school, if you're lucky enough, college, if you're even luckier, you get, some post-bac degree. If you're talking about home ownership, very clear, apartment, small house, condo, big house. If you're lucky, empty nester, right? Small business, credit cards, home equity, maybe I have my own capital, abyss, bankable, right? And it's like, it's this abyss that we need to, I think the CDFIs have a very important role to fill. And I think we have to think about where we want to fill it. Where do we want to be? Like, are you going to be great at less than 250,000? Are you going to be great than less than 50,000? Are you going to be great at less than $1 million? And I'm going to tell you guys, this is going to be a big, big issue for us soon, because $7 trillion got added to the economy. Another $2 to $4 trillion to get added. I got my nerd glasses on, so bear with me here. So $10 trillion gets added to the economy. What do banks do when they get $10 trillion? They do higher loan amounts. Right? It's not rocket science. And so if we as CDFIs don't kind of get in line and think about that, and so to your point, Matt, if we don't become partners and we actually become lead sources for each other, then you're going to have book erosion, because predatory lenders are going to come in and rip your book apart. And then two, because the small business owner is not going to understand which way to go. And so that also leads to portfolio erosion. And so these are the things, again, that I think, a group like this and a cohort like this is amazing, because you guys get to meet each other, think about these things, talk about these from a local and a national perspective.
All right, thank you so much. So I apologize to those who still have questions in the chat, because we want to honor your time and end on time, but we can get to your questions afterwards. In written form. So I'm going to hand it back over to Allie for the last minute.
Actually going to be me, but no worries. We're one and the same, so it's totally fine. But yeah, just wanted to say thank you again so much to both of our speakers today. We are so thrilled to have you, learn from you, and hear about your experiences, and also really grateful for the conversation. And as we mentioned in the chat, we'll go ahead and circulate the slides straight after this session. The video will take a minute to download to our cloud, and we'll circulate the link and whatnot for everyone there. And for the questions that are remaining in the chat, we'll get them to our speakers and get back to you, as Sylvie mentioned, in written form. And then in terms of just another quick things in terms of just program updates more generally, your cohort lead should have received information about the technical assistance portion of the program that is forthcoming. So you'll be able to start scheduling that here now after this session. And for any questions there, especially for the cohort leads, again, take a look at that guidelines document. But beyond that, reach out to me, Allie, or Sylvie, and we'll be happy to get you connected. And yes, any other questions or anything that comes up, please don't hesitate to reach out. We're so excited to just continue moving through the program. So to be respectful of your time, we'll call it there, and we'll be in touch. Thank you.